In part 3, I will explain some key drivers for fintech growth, benefit of fintech, risk of fintech, and conclusion. I managed to identify 4 driving forces for fintech growth. First is new generations of users called millennials. They are mobile, more socially engaged, and desire superior apps to manage their financial transactions. They prefer convenient and efficient financial services via e-bank or other digital channels without leaving their home. As a result, it has weakened the role of traditional banking. Second, increasing demand from small and medium enterprises for a loan application without collateral and difficult conditions imposed by traditional banking. Not only fintech provides financial service for elites and high-ranking consumers in society, it expands the financial support for startups and SME, especially in rural areas. Through development of mobile technology, fintech is able to achieve lower operating costs and lower rate as compared to traditional banking. Third, the vigorous support in a form of basic infrastructure facilities and government regulation on fintech fosters supportive environment for fintech development. In the country other than Security Commission, the government had launched Malaysia Co-Investment Fund, MyChief, and Malaysia Digital Economy Corporation, MDEC, to be at the forefront of the digital agenda while safeguarding the investors' rights. And fourth, several technologies promote fintech development. For example, the artificial intelligence, big data business, and cloud computing are in widespread application, especially in financial services. Moreover, the blockchain technology has also been applied in a number of different areas, including financial services. Various technical instruments, especially for mobile devices and connectivity, as well as hardware and software, have been further improved decision making and minimize the risk. There has been a rapid growth of fintech across different areas like insurance, mobile payment, investment management, and fundraising. This has resulted in many benefits for consumers. First is convenience and speed. Fintech products are specially designed to deliver online via smartphones and tablets for convenient access by ordinary people. Fintech greatly speed up the rate of approval for finance or insurance process within 24 hours. Second is greater choice. Consumers benefit from a greater choice of cashless solution for business transactions that can be done remotely, regardless of location. Even if you live in a country that lacks of financing infrastructure, you can still get the financial support you need. Thanks to fintech, consumers' choices are not only limited to product or service offered by traditional banks anymore. Third, the cost is cheaper compared to traditional banks. Fintech companies may not need to invest money in a physical infrastructure like a branch network, so they are able to offer cheaper fees to consumers. Fintech firms not only enjoy lower operating costs, but they can more easily react to consumers' individual needs. Technology allows fintech companies to personalize products or services with information they have collected and stored from customers. Moreover, transactions are anonymous, allowing customers to bypass both bank and government regulators. Fintech growth will ultimately create enormous benefits for businesses and help empower them in the digital age. However, this technology inevitably leads to new risks, which includes number one, unclear rights. Unlike traditional banking systems, fintech companies use different business models. So one of a major risks for fintech is to keep pace with the regulator's latest updates. It is harder to ascertain which ones are regulated and what your rights are if something goes wrong. Fintechs will also have to consider different regulation in multiple territories should they operate internationally. Number two, lack of transparency also can be a problem because financial products are bought instantly online without ever meeting anyone face to face. In many cases, consumers are making a rash decision without better informed as some fintech products don't clearly state their fees or other costs. Sometimes the costs are hidden or are not revealed until after a consumer begins the sign-up process. Number three, data privacy risks. Financial products bought online involve high volume of payment and transaction of customer accounts, leave them vulnerable to theft. This theft could be by an employee or by external parties. They may have misused, sharing, and selling your personal data, and this opens up the possibility for you to be a prime target for new type of scams, fraud, and data breaches. And number four, financial exclusion. While technology increases choice and access for most consumers, it can exclude special groups of community who are computer illiterate, unemployed, low-income households, elderly, people with disability, and those in poverty. There is not much information on how fintechs are helping this community except for resorting to high-cost loans. Hopefully, fintech company will come up with an idea to ease people financial burden by offering budget management and profitable saving plan. As a conclusion, financial technology of fintech as it has come to be known gets a lot of attention for its extraordinary potential to change the financial services landscape. Fintech can help ordinary people access financial products securely and efficiently while reducing costs of services as well as providing the most vulnerable access to financial products. In many cases, fintech is claimed to be safer than traditional financial services, for example, the use of Bitcoin and the use of blockchain technology. Many fintech products are just variations of existing financial products and services. Since fintechs are still in its early adoption stage, the focus is on digital lending. Additionally, they provide consumers and businesses with innovative products or services through which to manage and control their money, whether it be app-based banking, investment platform, trading platforms, or artificial intelligence-led wealth management. However, it is important for consumers to be fully aware of the risks of these new products, such as risks in data privacy, the lack of transparency, and risk of financial exclusion. Next video will end my short discussion on fintech. Thank you for watching.
The finance industry is facing change of unprecedented speed. To keep up, banks are embracing innovation and charging ahead with fintech strategies. But it's important to get behind the buzzwords and understand the reality and risks of new technologies. AI and machine learning is having one of the largest impacts on finance today. It is already being deployed in investment management, fraud detection, and risk management. Most AI solutions are provided by external companies, increasing a bank's third-party risk. There are also no international regulatory standards, so should this new technology lead to losses, there may be a lack of clarity about where responsibility for this falls. There are a lot of big expectations around distributed ledger technologies, and investment is pouring into blockchain especially. Blockchain is not a silver bullet, and improper implementation could harm rather than help. Like AI, regulators are still working with exchanges to explore what oversight should look like. Integrating blockchain with legacy systems can also cause cybersecurity risks, which are harder to manage than within a private infrastructure. Digital banking is removing the need for costly physical infrastructure as customers go online and payments go card and contactless. Digital transformation has made the financial industry more vulnerable to cyber attacks, theft, and fraud. And it isn't just money up for grabs. Often criminals and hackers go after customer data, which leads to reputational risk down the line. After the global financial crisis, regulation became more complex. Through digitization and automation, RegTech can be a cost-effective solution. Partnering with RegTech firms often means sharing sensitive data, opening companies up to additional risks. And while the technology can speed up and simplify processes, humans will still be needed to oversee it. Risk managers should take a step back to evaluate their bank's innovation strategies and identify the risks lurking behind the buzzwords.